Securities, instrument and market features. So here we're going to get into more detail about asset-backed securities, starting with a discussion about covered bonds, then how these structures are used to further address credit risk. Then we'll have a discussion about non-mortgage asset-backed securities, and then finally into collateralized debt obligations. So as discussed, we'll be starting off with covered bonds, then types of credit enhancements. How do asset-backed securities have different structures to address credit risk? Then non-mortgage asset-backed securities and collateralized debt obligations. So let's get started with covered bonds. Now, from the previous learning module, you probably remember that I told you that the originate to distribute model, where the SPV was bankruptcy remote, and because of that, what was happening is that there was a pool that was originated and distributed by the bank to the SPV. And the argument was that, hey, the SPV is bankruptcy remote, so even if the bank goes down, even if the bank goes bankrupt, it will make no difference to the SPV because they have access to their own pool of assets, right? They are independent, and the securities they are issuing, the asset-backed securities they are issuing, can continue to get the money as the pool keeps paying them. So the investors are safe because this is bankruptcy remote. But what if the pool is garbage? Then what happens? Then obviously the asset-backed securities will default. So now to solve that problem, and how do we solve that problem? We don't let the bank off the hook. We say, hey, you are not going off the hook. If this pool is garbage, well, it is your responsibility, the bank, that you replace the pool with good loans, right? So if there are bad loans inside the pool, it's your responsibility to replace it with good loans. Which means if the bank stays connected to the pool, you cannot have this bankruptcy remote structure, right? You cannot have this bankruptcy remote structure. And what we have is this new one, which I'm about to show you. So what is this new one? Actually, this is not a new structure. It's an ancient structure from a place called Prussia, which was the name of what we know today as Germany. So this is actually a very, very old structure. From ancient Germany, and well, I wouldn't say ancient, but because ancient would be before modern history. So Prussia is part of history. But anyways, this is not a history lesson. The point is, covered bonds have existed in Europe for a long time, and now they are becoming very popular again because they keep the bank, the issuer bank, linked with the bond, right? And now how does that work? So first of all, you have that pool, you still have that pool of assets, let's say it's loans, and it's ring fenced, right? It's ring fenced. So which basically means that it's identified that this is the asset which is backing these securities, right? So the cover pool is there, right? The cover pool is there, but it stays on the balance sheet of the bank. In the previous example, in the previous learning module, you saw that what we were doing was we were transferring the ownership of that pool to the SPV. Here, that is not happening. Here, the pool stays on the balance sheet of the bank, but it is ring fenced, it is separately identified, and that cover pool is used to issue the covered bonds, right? And then if the bonds don't pay because the pool is not good, so the investors have a claim on the covered pool, so it is backed by the covered pool. But in addition to that, as well, they also have a recourse to the unencumbered assets of the issuer. So the bank doesn't get off the hook, right? It is that if this loan is not good, if this pool is not good, and there is a monitor that keeps reviewing the pool, right? So if the pool is not good, then the bank is responsible, and the bank has to actually replace the bad loans with good loans in the pool. It has to make sure that the pool remains healthy. So this is something that, of course, if was followed from the very beginning, wouldn't have resulted in the global financial crisis. Because, as we discussed in the previous learning module, the global financial crisis, the 2008 GFC, happened because these guys said, hey, look, this is bankruptcy remote. So even if the bank goes down, the SPV won't go down. So give it a very good rating. But in reality, the pool behind the SPV was not very good loans. It was subprime. And the credit rating agencies did a very bad job by giving it a bad rating. And the bank was originating these garbage loans because they were just going to transfer the risk to the investors and didn't care, right? So in this kind of a situation, in your covered bonds, that can't happen because the bank remains responsible, and those loans have to be replaced with good loans if they become bad. So this is a good structure. This is a good structure. So let's talk more about it. So covered bonds are senior debt obligations issued by a financial institution backed by a segregated, ring-fenced pool of assets that typically consist of commercial and residential mortgages or public sector assets. Now, they differ from your typical ABS because of these four reasons. Dual recourse nature, and we'll talk about all four of them on separate slides. So dual recourse nature, balance sheet impact, dynamic cover pool, and redemption regimes in the event of sponsor default. And because of these additional safety features, covered bonds usually have lower risk and therefore lower yield compared to your similar asset-backed securities. Now let's talk about each one of these 4 points, starting with dual recourse nature. So it's very simple. If the underlying pool is bad, well, then you can go after the bank. So this is a dual recourse nature, that not only do the investors have that pool with them, so the asset-backed security or the covered bonds, let's say the covered bonds are not only backed by the pool, but they have a dual recourse. They can even go to the bank if the pool doesn't do well, if the pool is not healthy, right? Balance sheet impact, the pool remains on the bank's balance sheet, right? It's not transferred to a separate SPV. So we don't have that bankruptcy remote concept over here. So the covered pool bondholders retain a top priority against the pool. So it's like a senior secured liability issued by the bank. It has a top priority claim. And it's a dynamic cover pool. So this is what really makes it different from your corporate bond, right? I mean, then you must be thinking, then what's the difference between a covered bond and a corporate bond? Because in the previous learning module, we talked about asset-backed securities being better than corporate bonds, right? Because corporate bond will be linked to the corporate family rating, and why covered bonds are different? Well, because this is a dynamic cover pool. It's not that the asset is static. It is not static. It's not fixed, right? It's dynamic, which means the financial institution must replace any non-performing assets or even any prepaid. If there is prepayment, so this takes care of the prepayment risk. Because if there is prepayment, they use that money to buy new loans, right? So that takes care of the prepayment risk. Or if there is some default, credit risk, if there is some default or credit risk, that is also taken care of because they replace the non-performing assets with good loans. So this dynamic nature of this cover pool is what really differentiates a normal corporate bond issued by a bank versus a covered bond. Right, of course, your normal ABS just passes through the cash flows in case of default, and even it passes through the prepayment risk. So we know about that, right? I mean, there's credit tranching for the default, and then there's time tranching for the prepayment risk. But that risk is still there. It's not eliminated. That risk is still there, and it is redistributed in different tranches through your normal ABS. But here in the dynamic cover pool, that risk is being eliminated to quite an extent by the bank replacing the bad loans or the early paid ones with new ones, with new healthy ones. Now, this area is a little bit complicated, the redemption regimes in the event of sponsor default, but you don't really need to know too much about it. Just know that there are three types of redemption regimes. One is the hard bullet covered bonds, then two is the soft bullet covered bonds, and three is the conditional pass-through covered bonds. And I'll just give you a high-level introduction to these three types of redemption regimes, and you don't worry about it too much, because of course there is a lot more detail that you can learn about this, but it's not required at this current level. So anyways, let me give you a little bit of a background. Initially, what we had in not ancient Germany, modern history Germany, where it was called Prussia, is something called a hard bullet covered bonds. Now, bullet structure, as you might remember, is that where you have your coupons, and then your entire principal coming at maturity. That is what we call a bullet structure. A hard bullet means that if you miss a payment, right? If you miss your maturity payment, then what happens is that a default is triggered, right? And this is too strict, I feel. We don't really use these anymore. Maybe in Germany they still prefer them, right? But other parts of Europe, they prefer now softer or the conditional pass-through bonds. The problem with hard bullet is that if the payment is missed, then a default is structured. Now, before I get into what happens when a default is triggered, why is the payment missed, and why is it highly likely that a payment can be missed? See, you have to understand the nature of the underlying pool. It's mortgages, and sometimes it happens that payments are not what you thought they would be. So a hard bullet covered bond has absolutely no flexibility, right? If the payment is not made on as per the original schedule, then a default is triggered, and what happens is that the bank is then forced to liquidate the assets. Now, that could be a bad decision, because maybe it's just a difficult economic situation at the time, and those assets, if you are forced to liquidate them, might not be sold at very good prices, right? Maybe there is a recession, maybe everything is down, and you might actually lose money. It might be more smart, it might be smarter, it might be more sensible to actually wait for the market to recover, for the economic recession to pass, and then sell the assets at a better rate, right? But the hard bullet doesn't do that. You miss the payment and that's it. The default is triggered and you're forced to sell the assets. The bond payments are accelerated, which basically means that the underlying assets have to be liquidated, right? Only then you will be able to accelerate the payment. How will you accelerate the payment? You will have to sell whatever pool assets there are. Pool assets have to be liquidated, and that's not good, because it might be that you're in a recession. That is why you miss the payment to start with, right? So soft bullet is better, and conditional pass-through is even more flexible. Now, let me tell you what happens in the case of a soft bullet. In the case of a soft bullet, what happens is, let's say you missed the payment, right? You didn't make it on the maturity date. Let's say this was 2025 December, and you missed it. It's all right. You can pay it. Let's say we'll extend it another 12 months, and we'll say, okay, no problem, pay it by December 2026. So what you have over here is like a 12 month extension. It's flexible, but it's not like open-ended flexible. It's usually having a flexibility of 12 months. Right, the soft bullet, which is good, because then when the bank gets an opportunity to try and recover from the situation and sell those assets at decent prices, better prices. They have like a 12-month window to do that, right? So it is better than the hard bullet. Now, conditional pass through is even more flexible. There is no date, no fixed date over here, right? It's like an open ended. It's like an open ended. This is open ended situation. So that could be bad. I mean, you might be thinking, but that's not good, right? Because you don't know when you'll get the money back. Well, it's not really bad because it becomes a pass through, which means the bank cannot stop the cash. Whatever cash is coming will be passed through to the investors. So the investors get in the driving seat, but they're not going to take a hard stance and just liquidate all the assets, right? It'll just be like the softest sort of situation where the cash flow is just coming naturally and being passed through, right? So this I feel is probably the best. And it's probably the most popular now as well, the conditional pass through. Just one point I wanted to make over here is that credit rating agencies like soft and conditional. Now, this is a little counterintuitive, right? What does that mean? It means it's going to create some sort of a confusion in your mind, because if credit rating agencies give these better rating, that means the risk is lower in this, right? That's what you would think. But these two actually pay a higher return. The yield is higher on these because from an investor's perspective, they say, oh, you're not giving me a hard bullet, you're giving me a soft bullet, which means my payment can get delayed. Or you're giving me a conditional pass through with no fixed date, you have to give me a higher return. So these offer a higher return. But at the same time, if you look at it from the credit rating agency's perspective, they are giving them better ratings, which means they have lower risk. So these are actually very good. They're giving you a higher return and a lower risk. And why do you think credit rating agencies are giving them lower risk? Why do you think? Well, because credit rating agencies appreciate the fact that you don't have to be so hard-headed about the situation. Sometimes economic recession is there. You don't have to force sell the assets. It's better to actually have that flexibility and wait for the asset prices to recover and then sell them at better rates, right? So what happens is that they appreciate this flexibility and they feel that the credit risk is lower. The credit risk is lower in these more flexible scenarios. So that's why they're becoming more popular, the soft bullet and the conditional pass-through, because the return is higher and the bank is willing to pay a higher return because the bank is getting more flexibility here. And the investors are happy as well because their risk is lower and the return is higher. But some parts of Europe still like hard bullet, like Germany. Anyways, let us now move on to other ways to address credit risk. Now, coming back to the hard bullet, how can you keep a hard bullet, right? How can you keep a hard bullet and still reduce the credit risk? So let's say this is a bank and the bank has got this ring-fenced asset pool, right? And you've got your securities, your covered bonds. So we know that in the case of a hard bullet, what happens that is if you miss a payment, you miss the maturity payment on the date that it is supposed to be done, then you're forced to sell these assets, right? Which means, let's say these assets are worth 100 million and the bonds have been issued worth 100 million. But if there's a bad economic situation going on and these bonds are currently can be liquidated in the market for 80 million. If you sell them, you won't be able to recover your 100 million, right? So a solution to this is that they keep a buffer, that if the original bonds are worth, let's say 100 million, they won't sell assets, they won't sell securities worth 100, they'll only sell them worth 80. Which means even if this falls to 80, you can still force liquidate that portfolio and you can pay off the bond. So this is what we call over collateralization. Over collateralization, right? This is one way of doing it. Another way of doing it is, let's say you don't over collateralize, right? You don't over collateralize. You have 100 here. You have 100 here. You don't over collateralize. What you do is you could keep a difference in the rate. So weighted average coupon, what does that mean? The pool will have a lot of different loans, right? Some people might have taken a home loan paying 7%. Some people might have taken a home loan paying 6%. Someone might have taken a home loan paying 6.5%, right? So let's say the weighted average coupon is 6.5. That's what you're earning on this 100 million. But this is what the bank is earning on this 100 million. 6.5% of 100 million, which is going to be 6.5 million. But what they offer to the bondholders is lower. Let's say they offer them 6% coupon, right? So the coupon that is offered is lower than what you're actually earning. So you're keeping a spread there, right? So this is the other method called excess spread. And then you could, of course, also do your tranching. You could also do your credit tranching, which is something you've already discussed earlier. We've discussed earlier in the previous learning module that you could do credit tranching. There is one more thing you can do. You could get another bank, a third-party bank, or an insurance company, to provide like a guarantee, right? A surety bond or a bank guarantee. So that is also there. All of these are ways to address the credit risk. So in case if you have a hard bullet and they miss the payment, well, you could have over collateralization, which means even after selling the assets, you're able to recover the investors' money. Or you could have an excess spread, so that there is excess funds that pile up because of the difference in the spread, and those funds create a buffer. Or you can have credit tranching, that at least some of the layers are safe and only the equity tranche, the last one, is usually called the equity tranche because it behaves like equity. So this one faces the default risk. So you could take care of the risk that way as well by securing the senior tranches. Or you can get like a bank guarantee or a surety bond from an insurance company. So these are all the structures to assess credit risk. Let me take you through each one of them, right? The fourth one is the others, which I told you can be like a bank guarantee. This is not covered in detail in your curriculum, by the way. Bank guarantees and surety bonds, but it's not there in detail in your CFA curriculum. But this is there in practice, right? So in practice, you can use bank guarantees or surety bonds, or you could just go for over collateralization or excess spread or tranching, credit tranching, which is also called subordination. So what is over collateralization? The collateral exceeds the face value of the issued bonds, and this provides a safety cushion. Very, very straightforward concept. Excess spread, the weighted average coupon will be greater than the coupon that you're offering on the securities. So if your weighted average is 8, you're offering 6, there is a 2% spread, and that spread will be used to build up the reserve. Now, please differentiate between over collateralization and excess spread. In over collateralization, you have the reserve or the buffer to start with from day one. With excess spread, that buffer builds up over time. Subordination or credit tranching, this is something you have already learned in a separate learning module, right? And this is not time tranching, this is credit tranching, where we have a senior and a junior, right? The worst one is obviously going to be your equity tranche. This one, I think better name is mezzanine, the middle one, like you have a mezzanine floor. So the junior will be the equity tranche. Now again, guys, this is not time tranching, this is credit tranching, which means if the early payments are coming, right, they will go to the senior most tranche. So senior most tranche, even though they have low credit risk, but they have high prepayment risk, right? So it's not like they don't have any type of risk, they still face high prepayment risk. That's why you also have time tranching, but that is a separate concept. Other types of credit enhancements, bank guarantees, right, letters of credit, surety bonds, etc., not covered in the curriculum. So this is something we've already discussed in a previous learning module. Credit tranching, you have your equity tranche. This is your equity tranche. It faces the highest default risk or credit risk, and this one is the lowest credit risk. But this faces high, what does it face? High prepayment risk. It does face high prepayment risk, right? And these will be your mezzanine tranches, right? So obviously they are affected differently in the case of a default, and therefore they have different risk and different yields. This will have a low return, low yield. This will have a high yield, right? And your D, your class D, is called the equity tranche because of its residual nature, right? This is your equity tranche. And which one is your mezzanine? Class B is your mezzanine. Like you have a mezzanine floor between first and ground, right? In some countries you have that. And then of course you have your senior most tranche. Okay, I think let's take a break here, get fresh, and then come back, and then let's discuss non-mortgage asset-backed securities.